a tumultuous one for the cryptocurrency market. After a meteoric rise in 2021, the crypto market crashed in 2022, with Bitcoin losing over half of its value. There were a number of factors that contributed to this crash, including the collapse of the FTX Exchange, bankruptcy of Celcius, rising interest rates, and many more. Welcome to Crypto Cyclics. This channel is for educational purposes only and is not financial advice. And while we hope to provide valuable insights, we recommend you do your own research. Before we continue, make sure to like, share, and subscribe to keep updated with our content. And stay tuned until the end for a deep dive into all the factors that led to the crypto crash of 2022. So let's get right into it. Bitcoin, the poster child of cryptocurrencies, suffered a significant decline, with its value plummeting to roughly a quarter of what it had been just a year prior. But the setback wasn't confined to Bitcoin alone. The entire crypto industry found itself in a state of upheaval. The cataclysmic implosion of the cryptocurrency exchange FTX sent shockwaves throughout the digital currency ecosystem, leaving many stakeholders reeling from the consequences. As the dust began to settle, the cryptocurrency landscape stood at a crossroads. Some observers believe that 2022 may come to be regarded as a pivotal moment in the trajectory of virtual currencies. It was a year when these once touted assets lost their sheen, relegated to the fringes of the financial world, as a growing number of individuals approached them with skepticism and caution. Alternatively, 2022 might be seen as a period of agonizing growth for an industry still in its infancy, akin to the growing pains experienced by any emerging sector. Regardless of the eventual judgment passed in 2022, one thing remains certain. It was a year that will be etched into the annals of crypto history. While some may look back with trepidation, others will see it as a crucible in which the industry was tested, ultimately emerging either stronger or more resilient in the face of adversity. The only certainty in the world of cryptocurrencies is that the journey to the moon is fraught with turbulence, and each twist and turn along the way contributes to the evolving narrative of this dynamic and ever-changing sector. So what is FTX? FTX, short for Futures Exchange. FTX was launched off the reputation that Alameda Research had built in the industry as one of the biggest crypto traders by volume. Its stated focus was derivatives, leverage trading, and a professional approach with a goal to move the derivative space toward becoming institutional grade. FTX operated an international exchange out of the Bahamas. A separate entity, FTX.us, was set up in 2020 to legally service U.S. customers. By 2021, FTX became the second largest crypto exchange behind only Binance, worth some $30 billion before it all started to unravel. The demise of FTX marked a pivotal moment in the cryptocurrency landscape, and to grasp the full scope of this significant event, it's essential to delve into the series of events leading up to it. During the period from May to July 2022, a string of cryptocurrency market downturns, spearheaded by Terra Luna, instigated a cascading effect that resulted in several crypto lending platforms, including Celcius, BlockFi, and Voyager, facing insolvency. In response to these dire circumstances, FTX took proactive measures by offering financial support to BlockFi, which included an opportunity to acquire the New Jersey-based company, as well as initiating discussions to acquire the assets of Voyager. These strategic investments seem to solidify FTX's position as a formidable force in the midst of a turbulent cryptocurrency ecosystem. FTX chief executive Sam Bankman-Fried has bolstered the stumbling $900 crypto industry with his second bailout of a struggling digital assets company in as many weeks. What is Terra Luna? Terra stands as a prominent blockchain akin to the likes of Ethereum and Bitcoin. Much like Ethereum generates its native currency Ether, Terra's blockchain generates Luna as its native digital asset. However, the days leading up to the deep pegging event saw Luna trading at a notable value of $85. The creation of UST, a stablecoin in the Terra ecosystem, is an intricate process that involves the burning of Luna. For instance, during early May 2022, one Luna token could be exchanged for 85 UST, with a caveat that the Luna utilized in this exchange would be permanently removed from circulation, effectively burned. This deflationary protocol was conceived as a mechanism to underpin the long-term growth of Luna. The rationale behind this concept was that as more individuals embraced UST, more Luna would be burned, reducing its overall supply and thereby increasing its intrinsic value. To incentivize traders to engage in the process of burning Luna to create UST, the creators introduced an extraordinary 19.5% yield on staking, meaning you earned interest on assets. This yield was made possible through the Anchor protocol, which presented an appealing alternative to parking savings in traditional banks, offering the potential to earn nearly 20% in interest. Anchor, that promised annual percentage yields or APY of almost 20%, obscenely high. Notably, before the depegging event, a substantial portion of UST's circulating supply, amounting to around $14 billion, had been deposited into the staking scheme. The linchpin to UST maintaining its peg to the US dollar rested in the fact that 1 UST could always be redeemed for $1 worth of Luna. Consequently, if the value of UST ever dipped to 99 cents, astute traders could exploit the situation by acquiring a significant volume of UST and subsequently exchanging it for Luna, yielding a profit of 1 cent per token. This dynamic operated bidirectionally, while the increased demand for UST causing its price to rise, and the UST burned during exchanges for Luna effectively deflating its supply. To reinforce UST's peg, Terraform Labs founder and CEO Do Kwon introduced the Luna Foundation Guard, or LFG. This consortium was tasked with safeguarding the peg and boasted a substantial reserve, primarily in Bitcoin, totaling approximately $2.3 billion. The LFG held plans to augment this reserve to a staggering $10 billion, encompassing a diversified portfolio of crypto assets. Should USD fall below $1, Bitcoin reserves would be liquidated and the proceeds utilized to purchase UST to restore the peg. Conversely, if USD surpassed $1, creators would offload UST until its value reverted to $1, with the resultant profit being reinvested to expand the Bitcoin reserves.
Best understanding I can come to is that for some reason people started to lose some amount of confidence in the system as a whole, and as it did, it became increasingly hard for it to maintain its peg. Because the way you keep it is by people exchanging their dollar worth of Terra for a dollar worth of Luna and minting that. However, when the price of Luna starts to fall, minting more can have a depressing effect on the price of Luna. They tried to defend against this somewhat by using the Bitcoin reserve, which they had to deploy, but so far that seems like it's been insufficient.
The unfolding saga commenced on the fateful Saturday of May 7th, 2022. During this pivotal moment, a staggering amount exceeding $2 billion worth of UST was hastily unstaked, effectively withdrawn from the Anchor protocol, with a significant portion of these funds instantaneously entering the market for sale. The precipitous action prompted speculation and debate within the cryptocurrency community, with uncertainty prevailing as to whether this mass exodus was a response to a turbulent market period, accentuated by the notable rise in interest rates adversely impacting cryptocurrency valuations, or a more sinister attack on Terra's blockchain system. These colossal sell-offs exerted immense downward pressure on USD's value, causing it to plummet to a disconcerting 91 cents. In the ensuing chaos, astute traders endeavored to exploit arbitrage opportunities, seeking to exchange their USD holdings, valued at 90 cents, for an equivalent worth of Luna, which held its peg. However, their endeavors encountered a significant obstacle. The protocol allowed for the burning of only $100 million worth of UST for Luna on a daily basis, constraining their arbitrage activities. As apprehension and uncertainty pervaded the market, investors, already already skittish amid the prevailing gloomy atmosphere, rushed to divest themselves of their USD holdings as the stablecoin struggled to maintain its peg. This tumultuous period saw USD's value oscillating precariously between 30 cents and 50 cents in the weeks following its initial depegging. However, as the dust began to settle, USD's value found a sobering equilibrium, stubbornly maintaining a low valuation of less than 20 cents. This dramatic plunge in value culminated in a significant erosion of USD's market capitalization, which had stood at an impressive $18 billion in the early days of May.
Luna hyperinflated over 8,000% in a matter of just 2 days, and there is now trillions of Luna in circulation. This is all augmented by the fact that this ecosystem was under-collateralized by its Bitcoin reserves, so people are incentivized to not be left in the dark and flee for the doors and be the first out.
Back to FTX. On November 2, 2022, a significant revelation emerged as leaked financial documents from Alameda Research, a sister cryptocurrency trading firm to FTX, also founded by Sam Bankman-Fried, known as SBF, unveiled a strikingly intimate connection between the trading firm and FTX, surpassing previous suspicions. These documents shed light on a remarkable dependency, with a substantial portion of Alameda Research's assets being firmly anchored in the FTX native token FTT. In essence, the financial health of Alameda Research was inextricably linked to a cryptocurrency generated by FTX. Remarkably, each FTT token carried a value of approximately $25.50 at that point in time, underscoring the magnitude of this interdependence. Additionally, bankruptcy filings showed that Alameda Research extended loans totaling $4.1 billion to associated entities. Notably, this included a substantial loan of $1 billion to SBF.
Alameda Research, the venture capital and sister trading firm of FTX, made $4.1 billion in loans to related parties, including $1 billion for former CEO Sam Bankman-Fried, according to the bankruptcy filings. Do we know what these loans were used for?
That is something that we do not know, and, the liquidators are trying very hard to figure out the paper trail. We do know that Sam Bankman-Fried, was doing a lot using his own personal money. We know that he was a large Politico donor. We know that he had personally bought, vast number of shares, hundreds of millions of dollars worth of Robinhood stock. He had personally backed some venture capital, non-crypto venture investments, like $500 million to Anthropic AI, which is an AI research firm. And so it remains to be seen if, some of the monies that went to that was actually taken from Alameda, and if it was taken from Alameda, did Alameda also get those funds as a loan from FTX? And so it's not only another thing that's really interesting is kind of how these different entities, Alameda, FTX, FTX US, also kind of made loans among themselves.
November 6th was essentially the beginning to the end of FTX. Binance's CEO Changpeng Zhao publicly disclosed the company's intention to divest its substantial holdings of FTT. In a swift response, Alameda Research's CEO Caroline Ellison expressed Alameda's willingness to purchase these tokens from Binance, offering a price of $22 per token. In the wake of this announcement, the price of FTT exhibited rapid fluctuations with a precipitous drop of up to 10%, at times falling below the $22 threshold on the same day. Just 2 days later, FTT experienced a substantial decline, dropping to below $6. Around the same time, CZ disclosed that Binance had initiated a non-binding agreement with the intention of acquiring FTX in its entirety. However, this acquisition hinged upon the completion of a comprehensive due diligence assessment of FTX's financial records. Then, SBF made an announcement, revealing the impending closure of Alameda Research. Simultaneously, regulatory authorities in the Bahamas took action by freezing FTX's assets. Adding to the turmoil, the entire team associated with the FTX Future Fund, inspired by the principles of effective altruism and previously responsible for allocating $160 million to diverse projects, tendered their resignations. On November 11th, FTX.us, Alameda, and numerous affiliated subsidiaries filed for bankruptcy in the United States. In a significant leadership shift, SBF resigned from his position as CEO and was succeeded by John J. Ray III, renowned for overseeing the liquidation of Enron. Adding to the day's chaos, FTX fell victim to a hacking incident, resulting in the unauthorized transfer of over $300 million from the exchange. In response to this breach, FTX advised its users to uninstall its mobile application. FTX attributed some of the shortfall to hacks, saying that $323 million in crypto had been hacked from FTX's international exchange, and $90 million had been hacked from its US exchange. On December 12th, just before his anticipated trip to the United States to provide testimony before Congress, SBF found himself detained in the Bahamas. The arrest came following a notification from the United States to the Bahamian government, indicating the filing of fraud charges against SBF and the intent to pursue his extradition. SBF's request for bail was denied, and he was subsequently incarcerated in a Fox Hilton located in the nation. A week later, FTX co-founder Gary Wang entered plea guilt regarding a range of charges, which encompassed fraud, securities fraud, and commodities fraud. In contrast, SBF persisted in asserting innocence. Before he was arrested Monday, disgraced FTX founder and former CEO Sam Bankman-Fried was planning to testify before Congress on Tuesday about the dramatic collapse of his cryptocurrency exchange. However, this all came to an end on February 23, 2023, when an indictment against SBF was public, shedding light on additional charges he was confronted with, which included bank fraud and unlicensed money transmitting operation. Consequently, his legal troubles escalated, bringing the total count of charges against him to potentially 12 in a trial slated to commence in October.
Carl, these new charges now really ratchet up the level of seriousness for Sam Bankman-Fried, and he could be facing additional time if the government is able to prove its case in this slew of new charges just added to the FTX case here. To the political contribution issues, here's what the new indictment says about political contribution, the scale of this effort. They're saying that Sam Bankman-Fried, the defendant, and his co-conspirators made over 300 political contributions totaling millions of dollars that were unlawful because they were made in the name of a straw donor or paid for with corporate funds. So what the indictment is saying here is that there was a massive effort to influence the political system here in Washington by Sam Bankman-Fried by putting money in a system that he didn't want people to know he was pumping into the system. In the indictment, they say that the defendant and his co-conspirators recorded outgoing wire transfers from Alameda, the hedge fund, to individuals' bank accounts for purposes of making contributions as just loans or expenses. Of course, that's against federal election rules.
In retrospect, the tumultuous chain of events that unfolded in the world of cryptocurrencies, involving the rise and fall of FTX and its key figures, serves as a stark reminder of the inherent volatility and complexity within this dynamic industry. It is essential to recognize that while cryptocurrencies themselves are a revolutionary technology with transformative potential, they can be exploited and misused by unscrupulous actors. As we navigate the ever-evolving landscape of digital finance, it becomes increasingly apparent that the responsibility for ensuring the integrity of this space lies not with the technology itself, but rather with those who wield it. Thus, it is vital to emphasize that this isn't cryptocurrencies such as Bitcoin's fault, but the actions of individuals like SBF and others that require scrutiny and accountability. To safeguard your cryptocurrency holdings in an ever-evolving and sometimes uncertain landscape, it's important to prioritize security measures such as utilizing cold wallets. A cold wallet, unlike hot wallets connected to the internet, is a physical device or an offline software application, specifically designed to store digital assets securely. By keeping your cryptocurrencies in a cold wallet, you can protect funds from online threats like hacking and phishing attacks, which are often prevalent in the crypto world. Additionally, enabling two-factor authentication on exchange accounts, regularly updating passwords, and practicing caution when sharing personal information online are crucial steps in fortifying your defenses against potential threats. In an ecosystem that combines innovation with risk, responsible and proactive security practices empower individuals to have control over the digital assets. A cold wallet is a type of cryptocurrency wallet that securely stores your private crypto keys offline, usually on a physical device. If you're eager to explore some of the best gold wallets available for safeguarding your cryptocurrency, click on the video below to access a wealth of valuable information. Discover top-notch options and insights on how to enhance the security of your digital assets with these trusted gold wallet solutions. That's all for today. What are your opinions on FTX and SBF's actions? What is the most important lesson you learned from the crypto crash of 2022? Hear your take on the comments below. Be sure to like, share, and subscribe if you enjoyed this video. Thanks for watching.